Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. We're going to dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, finding-value.com, where I dive deeper into all of these topics, subjects, looking for investment opportunities, sharing those opportunities with everybody in the community, sharing my experiences, what I know about the markets, and looking at the markets through my view of the three pillars of ratios, technical analysis, and market cycles. If that interests you, definitely hit up the special coupon code where you can save 50% off the first month only on a monthly membership and a larger discount on the yearly membership. And you can always switch from a monthly to a yearly if you're interested. So starting off, I've got some posts that I put up here first. I am going to kind of guide this one a little bit. So this is Steel ETF, SLX. It is actually a very good uh, observer of the commodity sector as a whole, even. COPX and other ETFs exhibit the same exact fractal pattern that SLX does. In fact, there's a whole bunch that exhibit the same type of patterns or fractals. Fractals are repeating patterns over time on different time frames and scales. And they all exhibit this pattern. What this pattern is a squeeze downtrend coming down into a false breakdown, a move higher, and then what is that? A double bottom. So this is the downtrend here. This is the bottoming pattern here. And then we started the bull market in 2020, which was the ultimate bottom. We broke out of this, we'll call it neckline, for a lack of a better word, resistance neckline of the double bottom. We did a retest on top of it. Now we're going into a bull market with time. And all of them exhibit this type of pattern. COPX, there's other ones like uranium, URA, if you look, has the same pattern, and so forth. So what I would do is, rather than trying to trade the small little wiggles, I would try to trade the big pattern, which started in 2020. That's your commodity super cycle. Now, people don't look at things from long-term time perspectives because they're so focused on week-to-week, month-to-month performance, maybe even quarterly-to-quarterly performance. I look at the big picture view. I look at this at 2020 is the bottom, and then I start sizing up how much further can we run to the upside. And I think it's going to be ridiculous, a ridiculous move. And I'll get into why I think that. But keep in mind, this is across all of commodities, not just steel and not just copper. It's in uranium, it's in oil, it's in all sorts of things. So this is a ratio, the commodities to Dow ratio. Everyone who's been with me for a while, they know this chart pretty well. This is basically your undervaluation of commodities against other things in the world, and that's all that matters. It's all relative. It's relative valuation. You can't look at things from the viewpoint of a dollar's value because the dollar's value is declining rapidly. So you need to look at an asset versus asset comparison. And this right here is basically the cheapest we've been outside of the 60s, and that's about it. The 60s and where we are today. The cheapest where commodities are undervalued in relationship to financial assets. Now, what I do is I take this, what we learned here. Okay, so commodities are undervalued. Then I pair that with the technicals in here. So I'm adding things together. Oh, look, we've broken out of the base for commodities. Oh, look, commodities are about as cheap as they've ever been. You need to start logging that in the back of your head. You need to log this information. Okay, commodities are cheap. We've got bottoming patterns in commodities that have broken out of bottoms. So where do you think this is going to go with time? You can also look ahead at the fundamentals of each sector. You can look at oil, you can look at lithium, you can look at steel, you can look at all these different things, and there's a whole bunch of shortages out in the future between supply and demand. And what that means is that it'll exert an upward pressure on price. So we have upward pressure on price from the fundamentals in the future. We've got bottoming patterns in the technicals, and we are dramatically undervalued. So you start to add all this stuff up. It's just pieces of information. Now I'm scrolling through Twitter, and I'm reading this. So Trader says 100%, says $3,800 target for gold is only active after it clears that red continuation breakout line. Remember, never front run a possible breakout. Never front run a possible breakout. Well, I mean, gold's been moving up. When does gold go up? When interest rates go up. Our interest rates, did they break their 40-year downtrend? They did. They broke the 40-year downtrend. So what does he mean by don't break it until this line breaks out? Well, this is all short-term noise. So I want to read something from a book that I learned, and I want everybody to kind of listen to this. And it deals with trading versus lining up these big picture moves. So this is from Jesse Livermore, Reminiscences of a Stock Operator. I'm going to read it really, really quick for everyone so I can get that, so I can talk about this here, and hopefully it comes up now. There we go. Okay. It says, yes, Mr. Harwood, I still have it. He bought some stock that was a tip from someone else. Let me get this a little bit bigger here. Said Turkey, gratefully. Turkey's the old guy. Mr. Harwood is a guy who gave him a stock tip. Let me see if I can center this a little bit better here, guys, for your viewing pleasure. It was nice, Elmer, to think of the old chap. Well, now is the time to take your profit and get in again on the next dip, said Elmer, as if he had just made out the deposit slip for the old man. Failing to perceive enthusiastic gratitude in the beneficiary's face, Elmer went on, I've just sold every share I owned. From his voice and manner, you should have conservatively estimated it at 10,000 shares. But Mr. Partridge shook his head regretfully and whined, no, no, I can't do that. This is very similar to how I am. What? Yelled Elmer. I simply can't, said Mr. Partridge. He was in great trouble. Didn't I give you the tip to buy it? You did, Mr. Harwood, and I am grateful to you. Indeed, I am, sir. But hold on, let me talk. And didn't that stock go up 7 points in 10 days, didn't it? It did, and I'm much obliged to you, my dear boy. But I couldn't think of selling that stock. You couldn't, asked Elmer, beginning to look doubtful himself. It is a habit with most tip givers to be tip takers. No, I couldn't. Why not? And Elmer drew nearer. Why, this is a bull market. The old fellow said it as though he had given a long and detailed explanation. That's all right, said Elmer, looking angry because of his disappointment. I know this is a bull market as well as you do, but you'd better slip them that stock of yours and buy it back on the reaction or on the retest or when it comes back down. You might as well reduce the cost to yourself. My dear boy, said old Partridge, in great distress, my dear boy, if I sold that stock now, I'd lose my position. And then where would I be? Elmer Harwood threw up his hands, shook his head, and walked over to me to get sympathy. Can you beat it? I asked me in a stage whisper. I asked you, I didn't say anything. So I went on, I gave him a tip on Climax Motors. He buys 500 shares. He's got his 7 points profit, and I advise him to get out and buy him back on the reaction that's overdue even now. And what does he say when I tell him? He says that if he sells, he'll lose his job. What do you know about that? He says, I beg your pardon, Mr. Harwood. I didn't say I'd lose my job. Cut in, old turkey. I said I'd lose my position. And when you're as old as I am, and you've been through as many booms and panics as I have, you'll know that to lose your position is something nobody can afford, not even John D. Rockefeller. I hope the stock reacts and that you will be able to repurchase your line at a substantial concession, sir. But I myself can only trade in accordance with the experience of many years. I paid a high price for it, and I don't feel like throwing away a second tuition fee. But I am as much obliged to you as if I had the money in the bank. It's a bull market, you know. And he strutted away, leaving Elmer dazed. What old Mr. Partridge said did not mean much to me until I began to think about my own numerous failures to make as much money as I ought to when I was so right on the general market. The more I studied, the more I realized how wise that old chap was. He had evidently suffered from the same defect in his young days and knew his own human weaknesses. He would not lay himself open to temptation that experience had taught him was hard to resist and had always proved expensive to him, as it was to me. I think it was a long step forward in my trading education when I realized at last that when Mr. Partridge kept on telling the other customers, well, you know, this is a bull market, he really meant to tell them that the big money was not in the individual fluctuations, but in the main movements, that is, not in reading the tape, but in sizing up the entire market and its trend. That's where the big money's made. So when I go back and I read stuff like this, never front run a possible breakout. What do you mean? We're in a bull market. We are in a bull market, says Old Turkey. What are we trying to do playing the short-term movements? We already know gold's outperforming the SPX. This thing is all starting to turn. What do you mean, never front run a breakout? I'm already in it. I'm riding this thing. Coming down, the big money is not in the buying and selling, but in the waiting. That is what everyone needs to learn. Do you know what I am doing to get my positions? What I am doing to get my positions is I am taking advantage of people who are frustrated. I'm taking advantage of those who are selling at bottoms. I'm not listening to anyone but myself and my own thinking. Then I sit and I wait. And that's where the money's made. The big money. It's to size up the big move. It's to get in when it's in 2020 and to ride the big move, not to sell the small reactions in the stocks, these small little movements that everyone is worried about. Do you know when everyone's selling these small reactions that I'm buying on support? That's a retest. I'm doing opposite of everyone else. This opportunity in 2020 exists because people are afraid, because of fear, because of lack of sentiment or negative sentiment. We buy those. Non-profitable stocks are surging. Goldman Sachs non-profitable tech index has surged 66% since its April low. This gauge tracks high-growth tech names with negative earnings. By comparison, the S&P 500 has risen 31% over the same period, or less than half as much. This has been one of the sharpest rebounds in the history of unprofitable tech after a 33% drop between February and April. To put this into perspective, in 2020, the index soared over 300% before wiping out all of its gains during the 2022 bear market. Investors are piling back into speculative growth stocks. That's where money's going. Now, what keeps me from buying this? You know, a lot of people will say, well, this went up 30, 40, 50% or whatever, right? Or however much percent this went up even. Does that mean I should be there? No, it doesn't. Just because something goes up doesn't mean that you should be there. You should be where the value is. That's what protects your bacon. Going into this and chasing, That's where you get knife sorted. You know, like a sword just cuts you in half. That's where risk is. Risk is the ability to identify when something is overvalued. And maybe that's overvalued. And it also tells you where you're at in the cycle. If everyone's running into speculative growth stocks, well, we got a bunch of money floating around this market here. Coming down, did you check your stocks today? So, quote of the day, a bull market is when you check the prices of your stocks every day to see how much money you've made. A bear market is when you don't bother to look anymore. How much truth is in that? When things go down rapidly, I don't want to look. I'll be honest. I don't want to look either. The Permian isn't an oil basin, it's a water basin. For every barrel of oil in the Permian, 4 to 12 barrels of water come up with it. It's not just a water problem, it's a clear sign of shale's looming doom. So, what this is the water cut. As your water cut increases, it means that the field is getting older and it's less efficient. So, you're getting less and less oil with more and more water coming out. So, they call that the water cut. Permian is 77% water cut. 51% Eagleford, 58 Bakken, 67 Appalachia. That's pretty bad, actually. That's pretty bad. Kobayashi letter. The U.S. manufacturing sector is under serious pressure. The Richmond Fed Manufacturing Index dropped to minus 20 points in July, the second lowest since the 2020 pandemic. This marks its 19th consecutive negative reading. Concerningly, 6-month capex outlook fell to minus 19 points, the lowest since 2008. This signals a continued slowdown in business investment and economic activity within the manufacturing sector. The capex expectations index has been in a downtrend for 4 years, one of the longest declines on record. U.S. manufacturers need help, and you can see the decline here. Let's go back up. Remember that steel chart I had all the way up here? The decline was from here onward. It was in this section where we consolidated. Did you notice that the consolidation was sideways? That could be from inflation. So it's an inflationary move. We consolidated sideways because manufacturing is weak, and we're waiting for that to strengthen again, which is going to go into a very big bull market. So that's how I read this. When I look at some of these things, I read that and I say, okay, I remember the SLX chart. I remember where copper is trading. So we are getting weakness, and we could be bottoming. We'll see. And maybe the worst is behind us. But we're doing it in an inflationary environment. So it's holding up all of these commodity companies and stocks and sectors. So what happens is you break out of the base, we get slowdown like we've experienced here, but they're sitting on top of the pattern. Oil's doing the same thing. It's sitting on top of the pattern. That is where you need to notice. Mr. Old Turkey would say, hey, you know what? We're in a bull market. Yes, we are. The big money's made in the waiting. The big money's made in sizing up the entire big move, the long-term move. Red or blue, the national debt goes up. The only thing both parties can agree on is sending the bill to future generations. Next stop, 38 trillion. That's where the inflation's coming from. It's coming from here. And it doesn't matter who your president is. It doesn't matter who you vote in. Up, 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 up. It's the design of the system. And it's going to keep going up because it needs to. It has to. Otherwise, the system collapses. The best one-liners in investing come from Charlie Munger. His lesser-known insights are just as powerful. Well, let's see what he has to say. Wisdom, acknowledging what you don't know, is the dawning of wisdom. Every choice has a hidden cost. Intelligent people make decisions based on opportunity cost. Don't waste time. If something's too hard, we move on to something else. What could be simpler than that? Choose wisely. Avoid working directly under somebody you don't admire and don't want to be like. Man, that's a strong quote. So me personally, I've never worked directly under anybody that I've admired, and I don't want to be like any of them. Maybe that was my problem. Collaborate. Everybody engaged in complex work needs colleagues. Just the discipline of having to put your thoughts in order with somebody else is a very useful thing. Debt. The first chance you have to avoid a loss from a foolish loan is by refusing to make it. There is no second chance. Don't stop reading. If wisdom is what you're after, you're going to spend a lot of time on your butt reading. Everyone's a genius in a bull market. Bull markets go to people's heads. If you're a duck on a pond and it's rising due to a downpour, you start going up in the world, but you think it's you and not the pond. Capitalism. Capitalism is a pretty brutal place. I regard it as very unfair, but capitalism without failure is like religion without hell. Avoid people with overconfidence. I try to get rid of people who are always confident and confidently answer questions about which they don't have any real knowledge. Know your circle of competence. I don't invest in what I don't understand, and I don't want to understand Facebook. There's a lot of this going on. I avoid a lot of companies myself because I feel like it's not my forte. Good businesses. Good businesses can survive a little bad management. Perfect wisdom. You don't have to be perfect. You don't have to have perfect wisdom to get very rich. Just a bit better than average over a long period of time. Failures. It's good habit to trumpet your failures and be quiet about your successes. Strategy. Strategic plans cause more dumb decisions than anything else in America. And that's it for the quotes today. We've got U.S. mortgage applications have just surged nearly 11% in a single week, refinancing up 23%, ARMs at their highest since 2022. Can you imagine what would happen if the Fed actually cut rates? Now, we had a little bit of a move lower in mortgage rates, and this is what's going on. 11% in a single week, refinancing up 23%, ARMs at the second highest since 2022. The Mortgage Bankers Association just reported an 11% in overall applications, 23% in refinancing, 25% jump in adjustable rate mortgages, ARMs. Why the surge? Rates dipped. The 30-year fixed went to 6.67%. The 15-year fixed is at a little bit below 6. 5/1 ARMs is 5.8. Even a small drop has unleashed demand. Imagine what a long overdue Fed rate cut would do if mortgage rates were to follow. Now, the Fed cutting does not guarantee that mortgage rates will necessarily fall. Refinancing now makes up nearly half of all applications. Meanwhile, demand is climbing. Purchase index up 1% from last week, 17% higher than this time last year. Yes, despite high prices, Americans want to buy. The Fed has been crushing the housing market with sky-high rates for 3 years. But now the data shows the truth. The market is ready to roar back to life if the Fed gets out of the way. I just want to make one comment too. In the back of my head, Warren Buffett bought Lennar Corp and D.R. Horton, which is ticker symbol DHI. Do you think he knows that they're going to lower interest rates? I mean, maybe. I don't know. Maybe he knows something. Bottom line, mortgage demand is surging. Families are desperate for relief. The economy is begging for growth. If the Fed will just do the right thing, we could see a real estate boom that lifts the entire economy to even greater heights. You know what that is? An expansion phase of real estate. That's exactly what we're playing. And that, I think, will probably is what bears out. Here's another one. COVID aside, core inflation is at a higher level than any time in the past 25 years, and it's ticking up, and tariff effects are yet to fully manifest. Last time I checked the Fed's stated inflation target, it's still 2%. Based on data, they shouldn't cut. You know what this is? This is a break out of the base, and this is a retest. That's a retest thing. If they lower mortgage rates, and we go into an expansion phase of real estate, it's going to send this to the moon. We're going to see another wave of inflation if that occurs. That's exactly what I'm betting on. Commodities are cheap in relationship to financial assets. This is all part of the cycle. The real estate cycle, inflation, interest rates breaking the 40-year downtrend in the 10-year. It's all interconnected. Here's another one. Nobody's talking about silver miners. Do you know that this is a function of where we're at in the cycle? Inflation and interest rates going up, silver goes up. And look at, we've got SIL divided by SLV starting to break out. Yep, it's all part of the cycle. Here's Japan's Nikkei 225 is finally breaking out to new all-time highs. It took 35 years to surpass the 1989 highs. This is what I call a generational breakout in Japanese stocks. Check it out. 35-year base, and we're breaking to all-time highs. You know what causes this? A weaker dollar. Money flowing out away from US dollar-denominated assets and positioning in emerging markets. And this is a developed international market. That's what's happening. A picture's worth 1,000 words. Saudi crude exports in July and August. No increase in exports. Production went up. They consumed it internally. No exports. No export increase. Bullish oil. Freight futures AM update. Dry bulk. Capesize down 2%. Panamax flat. And tankers are both flat for VLCC and Suezmax. So that's all I've got for today, guys. That's where we're going to end it. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials at coupon code. And that's all I've got for today. So we'll catch you next time. This is Finding Value.